The borrowing program announced by the government today has come against the backdrop of a particular market, and that market is well summarized in this one chart. Between last year, at the start of the fiscal last year, and this year, you've seen almost 100 basis point increase in the 10-year bond yield, and the borrowing program today tries to prevent a further upside in these bond yields, which can be very detrimental, not just for the government's finances, but also more importantly for the economy. So the government has done two things. One, it has addressed to some extent the near-term supply-demand imbalance in the bond markets by reducing the first half borrowings. Only 2.88 lakh crore being borrowed in the first half, as you know, and that's less than 50% of the total borrowings. So typically, they would front-load the borrowings. This year, they're actually not front-loading the borrowings in the hope that the second-year market conditions will be a little bit better. The other thing that they have tried to address is the oversupply of 10-year bonds in the market. And Swamijit Neogi of India Rating explained this to us well, said that 40 to 45% of the central government bonds are in the 10-year bucket, and about 70% of the state government bonds are in the 10-year bucket, which then means that this one benchmark bond tends to see a steep sort of change in the demand-supply dynamics when the demand from banks reduces as it has now. So the government has tried to address both the immediate sort of demand-supply imbalance overall in the government bond market and then the demand-supply imbalance in the 10-year bucket by changing the short-term tenure of the bonds that they are borrowing. They will be borrowing more in the 1 to 4 year bucket in particular, and then in the 5 to 9 year bucket as well. Those are two things that the government has done to address market concerns. Will this mean a short-term downside in bond yields? Yes, most market participants said that tomorrow they should see a positive reaction on the bond yield side. But I just want to caution that do not expect bond yields to come off very steeply, and the next chart will explain why I'm saying this. Now, remember last year, through most of the fiscal year, you had a surplus liquidity scenario. This is the banking liquidity indicator compiled by Bloomberg. This is the neutral line, and anything below that suggests surplus liquidity. So through most of last year, the government was borrowing between 15,000 to 18,000 crore per auction amid surplus liquidity. Still, bond yields moved up. Now you will be in a scenario where they will borrow lesser, 12,000 crore in the first half of the year per auction, but they will be doing this borrowing amidst neutral to deficient liquidity conditions. So while there could be some downside in bond yields, you would not expect a correction all the way back to the levels that we had seen at the start of the last fiscal year. The reason for that being that the liquidity scenario has changed as well. All the demonetization liquidity has flown out. The gap between deposit growth and credit growth has widened. Credit growth has picked up. Deposit growth has come off. So all of that will mean that pressure on bonds, or at least relatively higher bond yields, will persist.